Stop scrolling. I need you to imagine something before you look at a single number. Picture a calm ocean, then picture a sudden rogue wave that shoots straight up out of nowhere and vanishes just as fast. That wave wasn't natural, it was engineered. Because what happened to silver today was not a price move, it was a message. Everyone keeps asking the same question: did the bubble burst? But that question is already wrong. And the real question is this: who was supposed to panic and who quietly won? Today, silver didn't rise, it teleported, and then it was violently shoved back underwater. If you're new to markets, your stomach probably dropped faster than the price. Charts looked broken, candles looked cursed, social media screamed, "Top is in." But here's the uncomfortable truth no one tells you during moments like this. Real crashes don't look like this. Real collapses don't snap back. Real tops don't leave fingerprints. And today, left fingerprints everywhere. This wasn't chaos, this was choreography. Somewhere inside the plumbing of the global financial system, a switch flipped. Liquidity vanished. Algorithms smelled blood. And within minutes, leverage traders, people who thought they were riding a rocket, were turned into forced sellers. Not because they were wrong, but because they were early and overexposed. That long, ugly wick on the chart, that's not fear, that's rejection. It's the market saying, you tried to go too fast. And here's the part that should make your pulse slow down instead of spike. While the paper price was whipping like a hostage in a storm, nothing broke underneath it. Physical silver didn't panic. Gold didn't flinch. The monetary system didn't heal, but it didn't crack either. In fact, today revealed something far more dangerous for the banks and far more powerful for anyone who understands cycles. It showed us where the ceiling isn't and where the floor might be forming. Because bubbles don't get tested like this. They get believed. And today, belief was punished, while conviction was rewarded. In this breakdown, we're not reacting, we're dissecting. We're going to expose why this candle looks terrifying, why it's actually necessary, and why this may be the event that locks in the next phase of the silver shortage narrative. But first, we need to answer one uncomfortable question. If this wasn't a crash, then who was it designed to remove? Before we talk about silver, we need to talk about who bought it at the worst possible moment. Because markets don't move to punish everyone. They move to punish specific behavior. The people hurt today weren't investors. They were chasers. Sunday night, thin liquidity, ghost week volume. A gap opens higher, and suddenly silver is screaming upward. That's the trap. Late buyers see momentum. They see headlines. They see easy money. What they don't see is the order book. Banks see it clearly. They see empty depth. They see leveraged positioning stacked on one side of the boat. And they know something critical. Every leveraged trader leaves footprints. Stop-loss orders aren't secrets. They cluster. They form gravity wells. If you buy at 80, you don't put your stop at 79. You put it somewhere safe, like 75. And when thousands of people make the same safe decision, that level becomes a target. So here's what likely happened behind the curtain. Price was allowed to run, not because demand exploded, but because resistance disappeared. No sellers, no volume, just air. Then, at the moment leverage peaked, the sell orders hit. Not small ones, blocks. The first shove knocked price down a few dollars. That triggered early stops. Those stops became market sells. And suddenly the cascade began. This is how modern markets fall fast without anything being wrong. Not fear. Forced liquidation. Margin calls don't ask permission. They don't care about fundamentals. They don't wait for logic. They sell now. That waterfall you saw wasn't conviction reversing. It was leverage being rinsed out of the system like dirt from fabric. And here's the key insight most people miss. The same entities who sold into the high were waiting quietly at the bottom. This isn't conspiracy, it's structure. Sell high into thin air, force liquidation. Buy back lower from panicked traders who had no choice. That's not evil. That's how liquidity providers survive. But here's where the bubble burst narrative collapses. After the cascade, price stopped falling. Not gradually, abruptly. Which tells us something crucial stepped in. Not retail, not momentum traders. Size. Large patient buyers sitting at levels that mattered before the breakout. And when they stepped in, price snapped back. Not because sentiment healed, but because supply disappeared again. That bounce wasn't hope. It was absorption. So now we're left with a question that changes everything. If this was a true top, why did buyers appear instantly at prior resistance? And why didn't gold follow silver down the cliff? Because the answer determines whether today was the end or the cleansing before something much larger. And to see that, we have to look at the candle itself. Not emotionally, but surgically. Because that shooting star isn't telling the story most people think it is. That candle everyone is terrified of. Now let's dissect it, slowly, not as a headline, not as a meme, but as information. Technically, today printed what traders call a shooting star. Small body, long upper wick. Textbooks say this means rejection. They say it signals a top. But textbooks leave out one word that changes everything: context. A shooting star after months of exhaustion is dangerous. A shooting star during a low liquidity holiday vacuum is something else entirely, because that wick isn't fear. It's a failed acceleration. The market didn't collapse from 83, it was pushed back. There's a difference. Look at where the candle closed, not where it spiked. Despite all the chaos, despite the flash, despite the $9 intraday violence, silver still closed massively higher than last week. Strip away the wick and ask yourself a brutal question. If someone showed you a chart that opened near the lows and closed near the highs, would you call that bearish? Exactly. The wick exaggerates the emotion, not the structure. And structure is what matters. Now here's the data point that should have stopped panic in its tracks. Gold barely moved. When real bubbles burst, gold breaks first, or at least breaks with silver. Today, gold sat calmly at all-time highs, like an adult watching a child run too fast. That tells us the monetary thesis is intact. Silver didn't fail, it overshot. Silver is the high beta sibling. It always runs ahead, and then gets yanked back when it sprints too hard. That's not weakness, that's character. Now look at where price actually found support. Not randomly, not emotionally. Right around the prior breakout zone, old resistance becoming new support is not bearish behavior. It's textbook continuation. And when price bounced, it didn't drift. It snapped, which means buyers weren't hesitant. They were waiting for leverage to flush, waiting for forced selling, waiting for discounts created by panic. This is how strong trends behave. They don't go straight up, they shake people out. Here's the uncomfortable reality. If today didn't scare you at least a little, you weren't paying attention. But if today broke you, you were positioned wrong. And that distinction matters going forward, because now the market has done something critical. It has tested upside acceleration, cleared excess leverage, established a higher floor, and reset expectations, which sets the stage for the next phase. But before we talk about where silver might go, we need to talk about where it didn't go, because while paper traders were being liquidated, something very different was happening in the physical market. And that disconnect is where this story gets dangerous for the system. While the chart was bleeding red, something strange was happening off screen, something most people never check. The physical market didn't flinch. Let that sink in. When spot silver collapsed from the highs, logic says physical prices should have followed. Dealers should have slashed premiums. Inventory should have flooded back. That's what happens in real bear markets. But today, coin shops didn't panic. Websites didn't slash prices. Some premiums actually rose. That tells you everything. Because physical dealers don't trade emotions. They trade inventory risk. They know something paper traders forget. If silver snaps back $5 in an hour and you sold your inventory at the low, you just destroyed your business. So they don't play the volatility game. They treat paper price as noise and physical metal as scarce. That means today's crash wasn't believed. It wasn't trusted. It wasn't considered real. And here's the brutal truth for anyone waiting to buy the dip. If you weren't already logged in, funded, and lucky, you didn't get physical at $74. The window was minutes wide, if it existed at all, because no one was dumping bars, no one was rushing to unload ounces. There was no line of panic sellers. There was only algorithms dumping contracts. That's not a market collapse. That's a mechanical event. And mechanical events leave footprints. Here's another footprint most people missed: industrial buyers. Think about this from their perspective. You're a procurement manager for a solar manufacturer. You need silver. This isn't a trade, it's survival. You saw $83. Your heart rate spiked. Then you saw $74. You didn't panic. You celebrated. You locked supply. You hedged aggressively. You took delivery. That's why price didn't stay down. The deeper it dipped, the more real demand showed up, which means today didn't reduce demand. It pulled it forward. And that creates a dangerous dynamic, because when industrial demand absorbs paper selling and physical supply doesn't increase, the system tightens quietly, relentlessly. And this is where the silver shortage narrative stops being theory. Today's volatility gave us a glimpse of what happens when paper breaks briefly and physical refuses to follow. It showed us that below the chart, below the noise, there's a floor being built by buyers who don't care about candles. They care about ounces. And now that leverage has been flushed, those buyers are no longer competing with gamblers. They're alone. Which leads to the next uncomfortable question. If this kind of demand stepped in at $74, what happens when price revisits the highs with clean books? Because the answer to that question determines whether today was a warning or a rehearsal. And to understand that, we need to talk about volatility itself and why it's actually a tax. Volatility isn't random, it's selective. And today proved who pays the tax. If you were leveraged, futures, options, margin, you felt it in your chest. But if you held physical, Nothing changed. An ounce was still an ounce. That's the volatility tax. It doesn't punish ownership, it punishes exposure. And here's the part most people misunderstand. Volatility isn't a sign the market is weak. It's a sign the market is being prepared. Before major moves, markets don't glide. They convulse, they test nerves, they hunt stops, they force mistakes. Today's $9 swing wasn't designed to scare everyone. It was designed to remove specific participants. And now they're gone. Which gives us a critical insight into what that flash to $83 really was. It wasn't a top. It was price discovery leaking through the cracks. Think of it like a pressure valve. For a brief moment, suppression loosened, and silver showed us where it wants to trade when the system loses control. Then the grip tightened again. But here's the problem for the system. Once you see a level, you can't unsee it. $83 now exists in memory, in algorithms, in institutional models. It becomes a reference point, not a ceiling. And markets have a strange habit of revisiting reference points, especially after leverage has been cleared. Now look at currency behavior. This wasn't a dollar collapse. The dollar index barely moved. Silver fell and recovered against everything. That tells us this wasn't macro news. It wasn't rates. It wasn't geopolitics. It was internal market structure snapping under pressure. Too many longs, too much leverage, not enough depth. The boat tipped. Now it's upright again, but lighter, which makes it more stable going forward. Here's why that matters for January. If silver had gone straight from 65 to 100 without interruption, the crash later would have been catastrophic. That's how bull markets die. Instead, the market chose pain now. It flushed leverage early. It reset open interest. It made the asset look less extended and more attractive, especially to the kind of money that doesn't chase spikes. Pension money, institutional allocators, long-term capital. They don't buy parabolas. They buy pullbacks that don't break structure. And today, structure held, which means something counterintuitive. This crash may have increased the odds of the January effect. But before we get there, there's one more piece of psychology we have to confront. That long wick on the chart is doing something subtle. It's creating fear, and fear creates supply. Supply from people who want out at break even, which sets up the next battlefield. Because the real question now isn't whether silver is strong. It's whether it can absorb that supply when price returns to the highs. And that answer lies in who's coming next. The next buyers won't look like the last ones. The first wave was emotional, momentum chasers, leverage traders, people who needed price to go up now, they're gone. What's coming next is colder, slower, heavier, the kind of money that doesn't care about headlines or intraday candles. Well, let's talk about who actually moves silver when things get serious. First, industrial hedgers. They don't buy because they're bullish, they buy because they're exposed. Every solar panel manufacturer, every electronics supplier, every defense contractor with silver in their bill of materials, they don't care if silver is overbought. They care if they can secure supply 6 months from now. And after a day like today, their risk models light up because volatility is the enemy of procurement. When prices flash $83 and then rip $9 lower in minutes, that's not comfort. That's a warning. It says the market is thin, and thin markets force hedging earlier, not later, which means dips stop being sell-offs and start becoming inventory locks. Second, central bank adjacent money. No, central banks don't hoard silver, but sovereign funds, state-owned enterprises, and strategic stockpilers do. They don't announce it, they don't chase breakouts, they accumulate quietly when liquidity appears. And liquidity appeared today, briefly. That matters more than most people realize. Because when these players step in, they don't flip, they don't stop out, they don't care about RSI. They remove metal from circulation. Third, long-only funds. These are the ones who wait for chaos to pass. They want proof that sellers are exhausted. Today gave them that. A violent move down that couldn't hold, a recovery that wasn't news-driven, and a market that stabilized quickly once leverage was cleared. That's textbook entry after event risk. Now zoom out. Silver has always moved in phases. Phase 1, accumulation nobody notices. Phase 2, violent repricing people don't understand. Phase 3, public mania that ends badly. Today was phase 2 behavior without phase 3 participation. That's rare and dangerous for anyone still betting against it. But there's one more group we haven't talked about yet. The most underestimated force in this market. People who don't trade charts. They don't hedge. They don't manage risk models. They remember 2008. They remember shortages. They remember being locked out. They're the reason premiums don't fall. And they're waking up again. Because nothing reminds people that metals matter like watching a market break for 90 seconds. So now we're at an inflection point. Fear-based sellers are waiting at break-even, real buyers are waiting below, and price is stuck between memory and reality. Which sets up the final question. What breaks first? Paper confidence or physical availability? Because when that answer becomes obvious, there is no wick, there is no flash, there is only gap. Here's where the market stops being polite. Because gaps don't come from excitement, they come from absence. An absence of sellers, an absence of liquidity, an absence of trust in the paper price. Let's be precise about what creates a real silver gap. It's not retail piling in, retail arrives after. A gap happens when someone must buy and no one is willing to sell at the posted price. That's it. And today moved us closer to that condition. Why? Because paper sellers already fired their biggest weapon. Margin calls, stop cascades, forced liquidations. That was the nuclear option. You don't get to use it twice in the same range. The next time price approaches the highs, the same amount of selling simply won't be there. But demand? Demand didn't leave. It learned. Industrial buyers saw the fragility. Physical holders saw confirmation. Long-only funds saw structure hold, which means the next push-up will be asymmetric, slow on the way in, fast on the way out. And this is where paper confidence starts to crack. Because paper only works when everyone agrees it's convertible. The moment participants start doubting delivery, even quietly, behavior changes. They don't short aggressively. They don't write naked contracts. They reduce exposure. And reduced exposure means thinner books. Thinner books mean volatility upward. That's the part most people miss. Downside volatility flushes. Upside volatility reveals. Now let's talk about timing. Without dates, without hype. Markets don't break when everyone expects them to. They break when positioning is wrong. Right now, positioning is cautious. Scarred. Defensive. That's not how tops look. Tops are euphoric, crowded, confident. This market is none of those. It's nervous. And nervous markets don't collapse, they coil. Which brings us to the most important takeaway from today. The system showed its hand. It showed how price is controlled. It showed how leverage is punished, and it showed what happens when that control slips, even briefly. You don't need conspiracies. You don't need villains. You just need to understand mechanics. Paper sets the quote. Physical sets the floor. And today, the floor didn't move. That tells you the entire story. So when people ask, was today the top? They're asking the wrong question. The real question is, if $83 printed by accident, what prints when it's intentional? Because the next time silver moves like that, it won't come back in minutes. It won't leave a wick. It will leave silence and a new range. And by the time the headlines catch up, the opportunity won't. The storm is past, but the sea is never calm. You've watched $83 flash and collapse. You've seen stop cascades, margin liquidations, and algorithmic panic. You've seen weak hands fold and strong hands hold. Now ask yourself, who actually wins in this chaos? Not the gamblers, not the headline readers, not the retail FOMO crowd. The winners are the structural buyers, the pension funds, the industrial users, the holders who treat silver not as a ticker, but as real wealth. Today wasn't a crash. It was a cleansing, a test of patience, a stress test on leverage, a rehearsal for January. Because here's the truth. The next leg up won't start with a flash. It will start quietly. It will start with conviction. It will start with money that can't lose patience. And when that happens, the wicks of today will look like child's play. $83 will be the floor, not the ceiling. $100 won't be a target. It will be inevitable. Physical buyers understand this. They know that volatility on the screen is not the same as reality in hand. Every paper panic today was an open invitation for them to accumulate. And here's the final crucial lesson. Volatility is not your enemy. Leverage is, weak hands are, but patience, discipline, knowledge of mechanics, they are your weapon. So when someone asks, did the bubble burst? Smile. The bubble wasn't bursting. It was shaking out the weak, forcing clarity on the structure and paving the way for the next leg higher. The market has spoken. It showed the wicks. It showed the floors. It revealed the psychology. It revealed the mechanics. And if you were paying attention, you didn't just survive the day, you learned it. Remember this, the bull isn't dead, it's waking. And when it runs, it doesn't apologize. Hold your position, trust the floor, watch the algorithms blink in confusion, because the next move will belong to the prepared.